There's a famous business quote that says, "Nothing breeds success like success." And indeed, at SF Capital, we find this to be true. Our most successful business clients are also our most prolific, founding many successful ventures in addition to their core business. The dilemma that our clients face, however, is that some of these new businesses help our clients with their loan application and then others don't. And they run into extra questions, wasted time, and even declines when seeking finance. So today, we'll be looking at the myth, my other businesses don't impact my loan application. My name is Tommy Lim, and welcome to another Finance Mythbusters. A common belief held by many business owners is as long as their core business is profitable, they will be able to borrow money. While this is usually true, the amount that they can borrow can dramatically change, and it often depends on the stage and the scale of their other businesses. To understand this scenario better, we look at three questions. First, how does the bank know about your other businesses? Second, what does this mean for your loan application? And third, what can you do to optimize your borrowing outcome? So first, how does the bank know about your other businesses? You can't get away from the bank finding out about your other businesses simply by not telling them. This is because there are several ways for the bank to identify these entities as well as your relationship to them. The most common way is a credit check. A credit check is a report that the bank requests that states your previous loan applications, your conduct on any existing loans, as well as any company directorships that you hold. The credit report will also state the ACN of that company, the name of that company, as well as the date of your appointment to that directorship, therefore showing your ties to any other businesses. The second way is from your financial statements. Often, new ventures are funded by loans or distributions from your core business to the new venture. These transfers are often revealed in your financial statements, thereby prompting further questions from the bank. The third way is simply common sense. A savvy credit officer can quickly Google your name or look up your LinkedIn profile. If news articles and blog articles come up about your other businesses, or you list all of these businesses in your LinkedIn profile, this can be another giveaway to the bank. Next, we look at what does this mean for your loan application. Just because the bank finds out about these entities doesn't mean the end of your loan application. It's more important to know how the bank treats these entities in their assessment and what it means to your borrowing capacity. The main implication of these other entities is that it leads the bank towards a group assessment, something that we looked at in a previous video. For example, say your core business made a profit of $200,000 and a side business made a profit of $50,000. Your total servicing income would become $250,000, increasing your overall borrowing capacity. However, if your side business made a loss of $50,000, your total servicing income would reduce to $150,000, thereby decreasing your borrowing capacity. Another implication of these additional businesses is that you should expect to face more questions and more requests for information. You should be mentally prepared to handle these questions as well as collect the required information for the bank. An experienced broker, however, will know how to address any key issues up front, therefore reducing any unnecessary inquiry from the bank. The third consideration is that assessing more entities simply takes more time, and this is extra effort for your broker, for your accountant, and of course the bank. This extra work is likely to slow down your time to approval, so you should budget extra lead time when seeking finance for a complex loan scenario. Finally, let's look at what you can do to optimize your borrowing outcome. So you're now more prepared to handle more questions and take more time. But what can you do to make the process more efficient or even increase your desired borrowing capacity? Here are my tips. The first tip is being prepared. This means working with your accountant to have your financials ready before applying for the loan and being forthcoming with this information to your broker. An experienced mortgage broker will know how to assess this information to understand your group structure, your flow of income, and help you determine how to best position this information to the bank to get your loan approved. The second tip is to provide an accountant's letter as part of your loan application. Where relevant, an accountant's letter can be helpful in closing off early stage businesses so that they do not impact your borrowing capacity. A typical accountant's letter can state that these businesses are trading profitably, can meet their commitments as and when they fall due, or are not trading at all if these businesses are very early stage or even dormant companies. Your broker will be able to help you determine when an accountant's letter is required and can even help you draft the contents of this letter on your behalf to make sure the wording is right for the bank. The third tip is to consider a non-bank lender if your group financials are not ready or the return on effort is simply not worth it for a group assessment. The benefit of a non-bank lender is that they may only focus on the income of your core business and be less concerned about how your other businesses are performing. This was previously covered in a Finance Mythbusters earlier, and I'll share the link in the comments below. I hope this unpacks the myth, my other businesses don't impact my loan application. If you have any questions or comments, please feel free to reach out to any member of the SF Capital team. And if you found this information useful, please follow SF Capital on YouTube and social media. Thank you for watching Finance Mythbusters and see you in the final episode.